Hello everyone. In this session, I'm going to look at credit default swaps and how do you typically do the pricing of the credit default swaps, both using the non-conventional method or probably conventional method which was in existence before 2009, before the Big Bang has actually come into picture, where there was a kind of standardization of the credit default swaps. So before that, how was the CDSs typically priced versus now after the standardization, what is meant by standardization, and after the standardization, how am I able to do the computation for the pricing or the value of the CDS contracts? So these are the aspects that we are going to look at and we would address all these things using R. So we would be using two important packages that are already existing as a part of R. One, I would use a package called Credit R, which is helping in terms of pricing or finding the value of the CDS post the standardization. And I am also using another package called Credule, which is again for doing the pricing of the CDS using the standard kind of method which was before the standardization. So prior to the standardization, the traditional method or the conventional method for pricing the credit default swaps. So I'm going to look at both of them using R. Now, in this, first let's understand what are the credit default swaps and how do we really understand the transactions as a part of the credit default swap. So though the focus of this session is not getting into the theoretical aspect, but for someone who want to directly execute this in R based on the data, a basic background of credit default swaps is essential, and here my coverage is only to that extent. So if you want to get a good understanding of the credit default swap, the theoretical aspects of the credit default swaps, etc., I want you to refer to other articles and textbooks on credit default swap. Now, what is the standardization process that has come in for these credit default swaps? What are all standardized because of this standardization process, and what is the impact of the standardization on the pricing and the valuation of the instrument? So we'll talk about specifications of the CDS contract. So what are the inflows and the outflows to the various parties who have typically got into a credit default swap contract? Then, because of the standardization, some new terms had to come into a picture, which are something like upfront, right? So we need to understand what are all these things. Some kind of fees or premiums are actually coming into picture. So we have to understand the new terminology because of standardization. So I want to spend one slide to understand that aspect. So these four basically should give you the conceptual understanding of the CDS, both before the Big Bang and after the Big Bang, where the standardization of the CDS has occurred. And then we are getting into the process of pricing a CDS. We will use the Credule package first, which is like before the standardization process. What do we mean by pricing of a CDS? And based on the price that we have got, how do I really arrive at the credit curve based on the CDS spread that I am getting from this stage? And Now because of the standardization, instead of pricing, we are calling it as a value of the CDS contract. Why is it so, and how are we really interpreting that? And finally, some more important calculations regarding the credit default spread is what we are going to look at towards the end of the session. So these are the major areas that I want to touch base here. Getting started with the conceptual aspect. Definition wise, we all know CDS is a financial swap agreement. So here, simply put, I want to bring in three parties A, B, C. Okay, A is a lender to B. So B is typically a borrower. Now the other way of talking about is B might have issued a bond to borrow funds and A might have invested in that bond. In that case also A is a lender. Now A is having a kind of risk that B may default on the payment to A. So this is where A is looking at protecting himself against the default of this B. Now that is where C comes into picture. So A is trying to buy the protection from C. So A becomes the protection buyer from C, and C is actually acting as protection seller. So what it means here, if normally the agreement is between A and B where B has to pay A because A has already given a loan to B. But if B defaults, the corresponding compensation will come from C because the C is the protection seller. Now that is what is the agreement. So it's a financial swap agreement that the seller of CDS, who is C in this case, will compensate the buyer of CDS. A is the buyer of CDS. So we have seen buyer means he is the creditor of the reference loan. So he has lent B. So that is where he is becoming the CDS buyer in the event of a loan default by the debtor. So in case the B is defaulting on the loan, then because A has taken a protection from C, C would be compensating A to the extent of loss that A is facing because of B defaulting on the loan. So that is what is the typical credit default swap agreement. Now here when we talk about the credit events, any of the credit event occurring, the CDS payment would be done by the default protection seller to the protection buyer. So the default events could be the bankruptcy of the firm B or firm B failing to pay the agreed upon interest and the principal to A, even that is treated as a credit event, or any kind of loan restructure initiated for the loan that B has taken, even that would be treated as a credit default event. Now all these things, any one of these things occurring, it would be treated as a credit event, and once a credit event occurs, the protection seller has to compensate the protection buyer for the amount of loss that the party is getting because of the default of the reference entity. Reference entity is the bond of B. And this protection is not forever kind of stuff. There is a maturity date that is specified. So this protection will be lasting only up to the specified maturity date. Let's say it's a 5-year period. So the protection would be lasting for a 5-year period. So typically the instrument is designed for transferring credit risk. Now here initially the credit risk was existing with the party A because B may default, and that's the reason A is having a credit risk. Now through this agreement we are transferring the credit risk from A associated with this reference entity B is getting transferred from party A to party C. So party C now became the risk taker. A has reduced the risk by transferring the risk to C, because in case B is defaulting, it is now C who would be compensating A. A would not lose now because there is a C who would be compensating A for the amount of loss. So that's where we say seller of the CDS, who is the protection seller as well, protection seller or the seller of CDS, that party is insuring the buyer against some reference loan defaulting. So that's how the definition needs to be looked at. Some reference loan defaulting, I look at the seller of the CDS is insuring the buyer of the CDS. And just to get that kind of insurance, its word is insurance. So which means to get that kind of protection, the buyer of the CDS has to make premium payment. Right? The buyer of the CDS has to make the premium payment, which is a kind of at regular intervals. Generally, these premium payments are made quarterly. So there are different ways in which we talk about the payment. Either we talk in terms of a fee in dollar terms, or generally we talk about a spread, which is some kind of a percentage of the face value of the loan that is outstanding. So there is a series of premium payments that are done by the buyer of the CDS to the seller until the default event, until the credit event occurs. So as long as this buyer is paying the premiums, this contract is in force. And in case the default entity, in case the reference entity defaults, then the protection seller or the CDS seller will be compensating the protected buyer accordingly. If no default occurs during the period, it's only one party paying the premiums to the other, but in return this party will not get anything because the reference entity has not defaulted during the process. So that's how we have to understand. And the way the premium amount is typically computed is based on a default swap spread. So there's a spread that is typically computed, which is paid on the face value of the protection. As I have said, after April 2009, that is the typical period of the big bang in the credit default swap contracts. So there are some changes that have come to the contract and the way that they are traded. Now this way, the CDS has become more and more standardized. Right? Earlier it used to be a very customized and negotiated transactions between the various counterparties. But after this time period, the CDS has become more and more standardized, and because of which, just like your futures, CDS has become more in line with the futures. There is a kind of a central clearance that is happening on the CDS trades. So the T plus 0 trade processing is happening on that day of transaction itself. The processing is occurring, so resulting in overall increased operational efficiency. So that's one major reason the CDS's contracts have been very much standardized after 2009. So wherein now the coupons, here the coupons are typically, here the coupons when we are talking of, they are the spread that the buyer is paying, CDS buyer, protection buyer is paying to the protection seller. Instead of determining it for each transaction separately, these values are standardized. Now in US, in North America, they are typically standardized, like you have 100 basis points coupon or 500 basis points coupon. Only two majorly traded kind of instruments. So which is like 1% more or 5% more, right? So which is in other way, the way of talking about is the coupons could be either 1% or 5%, means the premium that has to be paid by the party, by the CDS buyer to the CDS seller could be either 100 basis points or 500 basis points. Whereas in reality, it may so happen that this party may have to pay 80 basis points only, or this may have to pay 550 basis points. But now with the standardized mechanism, there are only two different coupons, 100 basis points and 500 basis points to be paid by the protection buyer to the protection seller. So that much of standardization has come out. Even the coupon dates, instead of having any date, there are only 4 dates per year that have typically come out. So which is like a quarterly. So even that has standardized the overall process. The coupons, on the day on which the coupons will be paid, the maturity dates are also streamlined. So standardization has really brought in lots and lots of efficiency into the operations of the credit default swap. Now, talking about the standardization with respect to the dates, as I said, maturity dates are standard maturity dates are directly unadjusted. So they are quarterly, March, June, September and December 20th. They will be the maturity dates of the CDS. And coupon payment dates are just adjusted following the business day wise. Probably if the March, if I say March 20th, 2016 happens to be a Saturday, then the coupon payment date would be the next Monday. But if this happens to be a Friday, then the coupon payment date is also a Friday itself. So it's only adjusted for the business day. The next immediate business day is when the coupon payments will happen. And coupon payments are always standardized. I'll take the annual coupon, whatever is the number, divided by the 360, multiplied by the number of days in the accrual period. So it need not be 90 in all the periods. In some periods it could be lesser, some periods it could be more. So that is where the each coupon is typically computed. How much coupon has to be paid is computed through this mechanism. So the accrual period, whenever we are using the word accrual, it's the time for which the coupon is yet to be paid. So we are looking at the previous coupon payment date and through current coupon payment date minus 1. That is what we are calling as the accrual period. So when I am talking about 20th March is the previous coupon paid date, and now 20th June will be the next coupon paid date. I will find out up to 19th June inclusive, because the next coupon payment date will be 20th June. So I will look at up to 19th June and I'll try to find out how many days are there in this particular period. Rates are standardized as I have already specified. The coupon rates are either 100 basis points or 500 basis points, one of these two. Dates are standardized. Accrual start dates are also being standardized because they are purely based on the previous coupon payment date to the current coupon payment date minus 1. So the entire processing is becoming more easier and it maximizes the fungibility of the entire trading process. So we know that if I am going with a $10 million 100 basis points coupon standardized CDS contract, will pay exactly the same coupon to everyone. The coupon payment date is exactly the same, regardless of when you have really got into this CDS contract, what is the day on which you have entered into the CDS contract, really it does not matter. Even the maturity period does not matter. The reference entity also does not matter. So the only two things that are coming out is 100 or 500. That's it. So the coupon payment is determined based on the trade date. So whatever has to be the coupon payment, it is purely determined from this kind of a calculation. So if I look at a typical CDS contract, with respect to the trade date, we have a maturity date. So as we have already talked about, the maturity dates are very clear. They are March, June, September and December 20th. The coupon rate is frozen, 100 basis points or 500 basis points. Talking about the protection part, there is a legal protection. The effective date is from today minus 60 days for the credit events. Whereas protection wise, when we talk about the maturity, the protection is applicable until the maturity date, which has to be specified. And whatever is the amount that would be paid would be typically the par value minus the recovery. So there will be a recovery rate. So out of whatever is the face value that need to be paid, whatever is recoverable, that would be subtracted and the remaining would be treated as loss, and that much would be compensated by the protection seller to the protection buyer. Whereas from the protection buyer's perspective, the general contract, the premiums are paid on a quarterly basis and the accrual is typically determined based on actual by 360. Right, and the CDS dates are typically adjusted based on the business day. In case the maturity date falls on a weekend. Same thing goes with the coupon payment date. After the T+1 calendar, whatever is the next date that is going to come up, that would be the typical date on which the first coupon will be paid. And even the coupon payments, as we have already talked about, they are done on the working day next to the maturity date. So these are the various things that we have to remember as a part of the contract specification. Now, few important points because of this standardization. Now the premium is standardized. So as I have said earlier, it would have been possible if I did not standardize it. It would have been possible that my CDS premium should have been only 80 basis points. So it's like this. Before the standardization, when I was talking about CDS pricing, it is purely I'm computing how much premium should the protection buyer has to make to the protection seller. So that is typically computed. We will do that computation as well. So let's say if it works out to 80 basis points, but now because of standardization, there is no such thing called 80 basis point. Either the party has to pay 100 basis points or 500 basis points. So now let's assume that the party is paying 100 basis points as the premium. Whereas as per the risk, it's only 80 basis points that is supposed to be paid. So what generally happens is the protection seller will do an upfront compensation to the protection buyer to the extent of 20 basis points. And that is what we are calling as upfront. Similarly here, if this had come out to 120 basis points as per the regular calculation, but the party is paying only 100 basis points as the premium, it means again the compensation has to be, there is an upfront compensation from the protection buyer to the protection seller, because this party is ending up paying only 100 basis points every period, whereas as per the risk, the party's CDS is having a value of 120 basis points. So that is where we are talking about an upfront fee because of the standardized premium. If the premiums were not standardized, it means that the protection buyer would be paying this much as the premium every period. But because of the standardization, the premium that is paid only is this much. So maybe the premium that I would have paid under the old non-standard contract for the same maturity dates, for the same terms and conditions, it could be either lesser or higher than the standardized premium. Standardized premium is 100 basis point. So the premium that I should have paid would have been either 80 basis points or 120 basis points. So either of them is very much possible. So when the old number is lesser, when the regular premium or non-standardized premium is lesser than the standard premium, I would be receiving the upfront premium as a protection buyer. But if it is the other way, I have to pay the upfront premium to the protection seller. So that is how we are computing an upfront fee, and we are either receiving or making the payment of the upfront fee to the protection seller. And the way the upfront fee calculation is typically done, the calculation of the fee from the old premium, that's the next thing that I want to typically look at. It takes into account the discounting, the discount rates are considered, the possibility or the probability that the reference entity will default, at what point the reference entity is going to default. And once the reference entity is defaulting, obviously the premium need not be paid by the protection buyer from then onwards, because the party would be receiving the protection from the protection seller altogether. Even for doing this kind of calculation, we have a standard model in place, and based on that I should be able to compute this particular premium, which is based on the non-standard contract. And using this, and I'll compare it with the standardized contract based premiums. So this coupon is nothing but it's a premium. So I could clearly see what is the difference, and that difference as a basis points multiplied by the face value is what is going to turn around as the upfront fee for calculation purposes. Similarly, even though I am entering into the contract, so let's say the coupon dates are 20th March and 20th June. But let's say I have entered into the contract on 20th April. Still, the full coupon needs to be paid. Though I did not have the protection between 20th March to 20th April, I still need to pay the full coupon of 100 basis points. Again, I have some kind of a disadvantage. When I am not protected for 1 month, why should I typically pay the coupon for the entire period? Which also means, because I did not get the protection for this period, I would be compensated by the protection seller as a part of the upfront fee itself, because of the benefit that I did not get in the first period for some duration, because I did not enter into the contract on the maturity date or the coupon payment date. So, but that much of the amount, whatever is the difference, that would be adjusted and paid as a fee. But no discounting will be applicable on that particular value. Coming to how the CDSs are typically quoted in the market before the standardization. So as I have already specified, the CDS, when I say pricing of the CDS, it is purely the premium that has to be paid by the protection buyer to the protection seller throughout the life of the trade. That's it. And whatever is the number that comes out, that is the amount that is paid by the protection buyer to the protection seller, straightforward. Now, which means that number could have changed depending on various factors including the market condition. But because now everything is standardized, either it is 100 basis points or 500 basis points in America. So the premium that is paid throughout the life of the trade will not vary now with the market condition. So there is an upfront because of this reason, because of this differential, there is something called upfront, which could be either positive or negative, because as I have said, it's just the difference between the two. So if I am talking about the actual calculation being 100 basis points and the standard calculation is 100 basis point, 80 and 100, the difference between the two is minus 20 basis point. So if it is coming out to be negative, then it is an indication that the protection seller would be paying the upfront fee to the protection buyer, and if it is positive, then the protection buyer is going to pay a payment, upfront payment to the protection seller because of the differences between the standardized contract and a regular non-standardized contract, all else remaining equal. So this is the conceptual aspect behind the credit default spread. With this understanding, now let's get into how we can do the pricing of each of these contracts in R, right? Now, getting into the practical aspect, I want to go for pricing a CDS. So if I want, I can calculate the spread or the prices, right? Here we said this is based on the conventional method before the standardization. I want to calculate the spread of one or more CDSs of different maturity, right? Probably I may want to compute what is the what would be the premium to be paid for a 3-year CDS as well as for a 5-year CDS. So I may be interested in finding out the spreads associated with the different CDSs. So for that I should give the yield curve as an input. The yield curve is, let's say we are talking about the reference entity to be a AA rated bond. Now I can understand what is the yield curve of this AA rated bond. So I should specify probably for a 1 year, 2 year, 3 year, 4 year, let's say up to 7 years, or probably I may not have a 4-year bond at all. So I'm looking at the yield curve, 1-year yield curve, 2-year yield curve, 3-year yield curve, 7-year yield associated with a AA rated bond. So that is what I'm calling as the yield curve. And I should also give a credit curve, right? Just to understand, credit curve is nothing but it's a kind of a credit spread. When we are talking about credit curve, we are talking about a credit spread. So this is absolute yield for each of the years. And when we are talking about the credit spread, I'm trying to look at basically the spread between the treasury bond, the treasury securities of these maturities minus the yield of these maturities. Probably the other way, the yield on the AA rated securities minus the yield on the treasury securities with the same maturity. So that is what we are calling as a credit spread. The credit spread may be constant, credit spread may be increasing with the yield, may be decreasing with the yield. So I have to give those input. One, I am giving a yield curve. Two, I am giving a credit curve, based on which, based on the spread, we know we can compute the probability of default as well. So either I give the probability of default or I give the credit spread, based on which the overall CDS spread would be typically computed. Now as inputs, I have to give, so to this we require a Credule package. Let me try to install the Credule package. I think it's already installed on my system. So I am simply loading the Credule package, but in case it is not installed on your system, you can very well install the Credule package. I have simply loaded it. I would be using this function called price CDS. If I have to look at it, price CDS, what it actually contains. The main objective is it's doing the pricing of a credit default swap. It's a function that calculates the spreads of the credit default swaps. So I can give different credit default swaps of different maturities from a yield curve and a credit curve. So this could be the typical way in which this is computed. So if you look at the inputs that it is taking, first thing, tenure of the yield curve expressed in years. So let me first take yield curve tenure. Let me create these as different variables first. So that's the tenure of the yield curve. So let me call this yield curve tenure. So let me take it as 1, 2, 3, 4, 5, 6, 7. I'll take it up to 7 years, the yield curve. Right? Then the next input is yield curve rate. I have to give yield curve rate. To understand what the yield curve rate is, it's a discount rate for a particular tenure. So for each of the years, I want to find out what is my yield curve rate. So probably for 1 year, I will take it as 9%, which is 0.09. For 2 years, let me take it as 0.0925. Then I'll take it as 0.095. For 3 years, for 4 years, let me take it as again 0.095 itself. For 5 years, let me take it 0.0975. And for 6 years, let me take it as 0.1. And for 7 years also, let me take it as 0.1. Just probably we are taking some kind of numbers as the yield curves for each of the 7 years. So we are taking the discount rates continuously compounded for each of the periods. Then I have a credit curve tenure. So I should take the credit curve again for the entire period. Right, so but at least until the credit default swap period, it's better that I have the credit curve. Credit curve is talking about the spread between. So here I just need the tenure. So let me take the credit curve tenure as one more variable. So this one I can very well take 1, 2, 3, 4, 5 because I am more interested in pricing only a 5-year swap. I'll take it only 1, 2, 3, 4, 5. Then this is an important one, credit curve survival probability. So based on the probability of default, I would be able to compute the survival probability for a particular tenure. For this, I require what are the survival period. So probably if I say in the first case, the survival is 9.8 for 1 year. For 2 years, let me take it as 9.5. For 3 years, let me take it as 0.91. For 4 years, let me take it as 0.85. And 5 years, let me take it as 0.78. Some kind of numbers. Alright. So these are some of the numbers that I am willing to take as the credit curve survival probabilities over each of the periods. Probably this looks like a very heavy penalization for a AA kind of security, but just for example purpose I am typically taking those numbers. Then I need to give CDS tenure for what periods I want to compute the value of the credit default swap. So let me give the CDS tenure. So I want to talk about two CDSs. One is a 3-year CDS and the other one being a 5-year CDS. I want to find out recovery rates also because it's a AA security itself. In all the cases the credit rating is the same. So let me assume that the recovery rate is around 50%. So I'm giving it as 0.5. So in case the default occurs, which means the compensation has to be done only for the remaining 50%. Then the number of premiums that are paid per year It could be any one of them. Let me take all four of them. Why only one? Right, I'll take the number of premiums. So if it is a quarterly, that's a default kind of a scenario, but in some cases I'm doing a half yearly premium payment. The protection buyer is making the premium payments half yearly, in this case annual, in this case monthly. Let's see what is the kind of premium that is coming up in all the routes. Then the number of default intervals per year. Basically the default can occur at any of the periods. So in per month, the defaults can occur anywhere on a monthly kind of a basis. So that's what it means by per year. There could be a kind of 12 equally spread kind of defaults. And should I consider the accrued premium also? So that is what is coming out as true or false. So basically it's better that if I consider both of them, I'll take accrued premium as true, accrued premium as false, so that both of them are going to be computed. But yes, let me take only as true to start with, and then I'll change it to false as well. Now based on this, let me use the price CDS kind of a function. So I can use this function now. We have discussed on all these things. So let me use this price CDS function. We'll call it as CDS price, and I am using this function altogether. So let me not use it this way. Okay, the CDS price is very much no, but yeah, yield curve, tenure, all these inputs we have given, and that is what got assigned to CDS price. So let me take what the CDS price is being shown. So this is where it is showcasing that for a 3-year period, the CDS spread is 1.53%. Right, if I'm talking about a quarterly kind of a payment, the CDS spread is 1.53% for a 3-year period, and it is 2.26% for a 5-year period. This is based on quarterly. Now I want to change a few things. So though I'm giving all four of them here, it's only one that is getting considered. So if I'm setting this as number of premium years as 1, and then take care of this formula, right, this I take only as 1, all these things I take it, and this one also I take it only as true. Now if I look at CDS price, this is as per the annual. So if I am going with the annual, it is coming out as 1.59. So the spread, if I am going with an annual kind of a payment, it's coming out as 1.59% and 2.34% for this guy. And similarly, when I am doing monthly, this number comes out even lesser. Instead of saying I am going with monthly instead of annual, if I am setting number of premiums as 12, then I'll get my CDS price as 1.52%, because overall we are doing a frequent payment. So and it's working out to 2.24% for a 5-year CDS. Now, so for each of these different yields, depending on the kind of payment, we are having different CDS periods. Now, so we are getting the CDS spread, that is the premium that one party has to pay to the other. So it means in this example, it is 153 basis points that need to be paid by the protection buyer to the protection seller if he is going for a 3-year CDS, right? So it's actually 153 basis points. But now if he is getting into a 100 basis points payout only, This is where there is an upfront premium, upfront that needs to be paid now from a protection buyer to a protection seller, because protection buyer has 153 basis points to be paid every year, but every year and adjusted quarterly. But actually speaking, is paying only 100 basis points every period, every year adjusted quarterly. So this is one reason there is an upfront payment from one party to the other party. So the output wise, if you are looking at this, we are getting the tenure which we have given 3 and 5 years, and the spread which is the CDS spread for each of the tenure. So this is what is coming out as the CDS pricing, all else remaining the same. We have 7 period yield curve. This is how the yield curve rates are, and these are the survival probabilities for each of the periods computed based on the credit spread, computed based on the credit spreads, and based on these assuming the recovery rate as 0.5. But if you see a small change, let's make recovery rate, let's make it the standardized 0.4, and based on that, if I want to compute the CDS where we are talking about the quarterly premium payment scenario itself, all else remaining the same, and now if I look at the CDS price, it comes out to 1.84% for a 3-year. So 184 basis points has to be paid for a 3-year CDS, whereas 271 basis points have to be made for a 5-year CDS if the yield curves are going this way, credit curves and the credit survival probabilities are going in this particular manner. So that's how there is a default possible, and based on that default, this is the amount of CDS spread if the protection buyer is going for any kind of a protection. So based on that, I can also go with a credit curve. I want to look at what is the credit curve looking like. When I say credit curve, it's basically the yield minus the treasury bonds rate for each of these periods. I want to see how the credit curve is looking over the period. So basically, all else remaining the same, I'll use this function called bootstrap CDS. Right, probably let me use this function bootstrap CDS. So I'll take all the other things are already in place. If you see, we have discussed them. Yield curve tenure is something that I have already taken care of, right, which is 1 to 7 years. Yield curve rates for all the 7 years we have taken care of. I'll take them to be the same. CDS tenures we have taken for 3 years as well as 5 years. CDS spreads, okay, this is something that I did not take, so I'll take the CDS spreads as the output from the CDS spreads itself. So this is the one for a 3-year period. This is the CDS spread that I am having, and for a 5-year period this is the CDS spread. So CDS spread is given as one of the inputs. Recovery rate we have set it as 40%, so I can directly use the recovery rate as it is. Number of premiums per year, let me take it as quarterly itself, so I am setting it to 4. Number of defaults per year, let me take it as 12 itself, and finally accrued premium, let me take it as true. With all these things, now if I want to derive the credit curve for the 3-year and the 5-year period, now you could see here, for 3 years the survival probability approximately is worked out to 91.26. I have given it as 91. It worked out to 91.26 through the smoothing process. and for 5-year period it worked out to 78.37. That is what are the survival probabilities. The hazard rate has come out as 3.04% for a 3-year period, whereas the same has worked out to 7.61% for a 5-year period. So this is what is the credit curve talking of, right? The credit curve which is giving me the hazard rates for each of the periods. They look like they are increasing with the time, and that is how the credit based on these numbers the credit default swaps rate has also cropped up, and once I had the CDS rates I am able to compute the hazard rates that are associated for each of the periods. So the credit curve also could be computed back from the CDS spreads as well. So even the pricing of the credit securities can be done based on this hazard rate, and this hazard rate is again used for computing the spread, which we have seen in our earlier videos based on hazard rate how we are computing the credit spread as well. Now, so we got this. Then now let's bring in the standardization part, wherein I'm paying only 100 basis points. So now the part is clear, we are paying 100 basis points, and based on that I want to get into the overall contract process. For that I need to use the credit R package. We'll talk about using the credit R package for that purpose. So you can install the package. It's already installed, so I'm simply loading it. So there are a few things to understand in this package. If you use this CDS package, your use will signify your understanding and irrevocable acceptance of this license, right? So this is the based on this model it is typically created. Nothing in this license restricts your ability to use the ISDA standard model. So it's purely based on the ISDA standard model. So I have to say S to give the consent about the terms. So that is where the model, that is where the package gets fully loaded. Now in this we are using a function called CDS. So let me type what it means. So it's building a CDS class object given the inputs about the CDS contract. So some of the inputs that we give for the CDS contract: one, the name of the contract, name of the reference entity, probably some XYZ company. That is what is the name of the reference entity. It's actually optional. I don't need to give it. The contract type, it is default is SNAC, which is the standard North American contract, is what we are bringing in out here. The RED is again a kind of an optional, which is giving some kind of a code to the reference entity. So all these things are typically optional. Now these are some of the things. The date. Date is when the trade is actually executed. That's one thing. Let's say today, I want to give the today's date for the execution of the trade. Right? So I'll give the today's date as the execution of the trade. Then CDS par spread. So we are simply talking about what is the spread that came out with respect to the CDS par spread, which we have already computed. I'll take the same example where I have computed the CDS par spread. In this case, now with 40% we have taken the CDS par spread is 1.84%. So I'll take this and this as the CDS par spread. So let's go one by one. So the CDS par spread is one input that I'm giving out here. So typically it is like 1.84% is coming out to be the CDS par spread. That's something that we have computed using the earlier process. The maturity of the contract, it's a 3-year contract. and this is what is the par spread. In the other case, probably there is a 2.71%. So this has to be given in basis points. The CDS par spread has to be given in basis points. So I should give it as 184 basis points and 271 basis points. Then the maturity date of the contract, here it is 3 years, here it is 5 years. The tenure of the CDS contract, okay, the date, either I should give the date of the maturity or the tenure. So I can give the tenure as 3 and 5. Coupon quoted, if I am going with 100 coupon, I can quote the coupon as 100, which is the payment amount from a protection buyer to a seller on a regular basis. So which means now, though 184 has to be paid, only 100 is getting paid by the buyer to the seller, which means there is an upfront that needs to be computed, which would be a payment from the protection buyer to the protection seller. Whereas if the coupon that is quoted is 500, then it would be the other way. The protection seller would be compensating the protection buyer. The recovery rate by default it is 0.4, but otherwise I can very well change the recovery rate as well. The currency in which the CDS is denominated, by default I am taking the USD itself, and the notional amount of the underlying asset on which the payments are typically based, I should give that amount as well. So let me go with the usage. CDS, let me start using this, right? Val CDS is what I'm calling it as, wherein I'm taking CDS name equal to some XYZ is the name of the reference entity. Then I have the contract, it's a contract type, the default is SNAC itself. So right now I don't have too many options to change in the type of the contract. Then RED, as we have already specified, it's again a kind of a coding to the entity, so I can still give this as XYZ itself. These are some of the things. The date I can take as the current date, so that's why I am calling it as system date. I am directly taking it as the today's date itself, right? The spread, so the CDS spread which we have already given, the spread, if I don't give it, it will take it as 0. So I will take the CDS spread based on the earlier calculation. I'll take it as 184.35. So I have to give it in, can I give it for two of them together? Let me see, 184.35 is the spread for the first one, and it is 271.6 for the second one. Let me see if I can give for both of them. So these are the spreads that I have for two periods. Then instead of maturity, I'll give the tenure, one being a 3-year contract and the other one being a 5-year CDS contract. So I'm specifying those. In both the cases, I'm specifying the coupon as the 100 basis points itself because it's a standard contract. The recovery, I'll take it as default 0.04. Currency, I'll keep it as this, and notional, I'm keeping it as 10 million, the default setting itself. But otherwise, I can very well change the numbers as well. Now, this is how I am able to compute the value of this CDS, where the par spread is 184 basis point, but I'm paying only 100 basis points. Even in the second case where the par spread is 271 basis points, I'm still paying 100 basis points itself. So let me see what this output has given. We'll try to understand the whole computation coming out of this output. Okay, so here it is coming out as a few values got a problem. So this means I'll go one at a time. So let me not take the tenure as 3 and 5 initially. Let me go only with the 3-year CDS and let me take the spread to be only 184.35, only restricting to this to see if the model has got executed or not. And after that, anyhow, I can go ahead in terms of doing it for a 5-year period as well. So initially, let me see whether it's working for 3 years. Looks like yes, I have to give the things separately. Right, now a few important points out here. The contract type is standard North American contract. The currency is USD. We have given the alphanumeric code as XYZ. The entity name is XYZ. The date, which is the today's date, coming out as 15th February 2016. Based on that, these are the calculations that are being performed. The price working out to 97.6. I'll discuss about these things. There is an upfront which is positive, right? The upfront is positive to the worth of 215,000. So this is the amount that is paid by the protection buyer to the protection seller. If it is positive, it's the protection buyer paying to the protection seller. So at the beginning of the contract, it has to be 215,745 that has to be paid by the protection buyer to the protection seller. So let me now look at some of the output part that is coming out. The principal, okay, first it is the upfront, which is quoted in the currency amount. It is primarily introduced to reconcile the difference in the contract value due to difference between the fixed coupon and the conventional par spread. So fixed coupon is only 100, whereas the conventional par spread is 184. And because of which there is an upfront of 215 that is coming out. The accrual is coming out to 24,167. It is basically the difference between the last coupon paid till the current date. So the coupon is paid between the last coupon paid to till date, which is working out to 24,167. This minus this is what is coming out to be the principal. So the dirty upfront value minus the accrual is coming out to be the principal. Accrual is giving me the accrued interest amount. So these are some of the calculations that are being made, and based on this there is a kind of a computation happening on the probability of default. The probability of default for this security is working out to 8.96%. So that's the kind of a default probability that's coming up. Corresponding to it, the price is working out to 97.6. Then the spread is to the extent of 184.35. That is what is the actual CDS spread that we have got. And spread DV01, if you talk about the spread DV01, it is basically a sensitivity of the entire CDS contract, how the value of this CDS is going to change, to what extent the upfront value is going to change to a parallel shift in the term structure of the par spread. If the par spread increases by 1 unit, let's say from 184.35, let's say the par spread becomes 185.35. Let me make some important calculations here. So when the par spread is 184.35, I see that the upfront premium is 215.745, 215,745. And it has given that the spread DV01 is 2784. Now let me take this as 185.35. Everything remaining the same. Instead of 184.35, let me take it as 185.35. Right? All else remaining the same. Instead of spread being 184.35, I am taking 1 unit. 185.35, and based on that, if I am looking at Val CDS, it has worked out to 218,530. If you look at approximately, the difference is to the extent of 2784. Right, if you are looking at it, the difference is approximately, if you say 215745 plus 2784, the number should be more or less matching. You see, 218529 rounding up, issue 218530 should come up. So that is what it means, right? That is what a spread DV01. In case the spread has gone up by 1 unit, what is the equivalent increase in the upfront value? So which has worked out to 2783. So if the spread is increasing, that's the excess payment that needs to be done by the protection buyer to the protection seller. Similarly, we also have IRDV01, again a similar kind of a concept. So to what extent the upfront, when now we are talking about a value of the CDS, it's purely the upfront value. The upfront value would either increase or decrease for 1 basis point parallel increase in the interest rate curve. So if the interest rate curve increases by 1 basis point, right, the whole yield curve, the entire yield curve increases by 1 basis point, obviously we see that the spread would be increased accordingly. So if the interest rate curve is increased by 1 basis point, it looks like the whole upfront premium will fall by 37.64 dollars. And similarly, if the recovery rate increases by 1%, what is the change in the value of the upfront premium? So if the recovery rate increases by 1%, so from 40, if the recovery goes to 41, I see that the upfront will fall by 185. $185 would be the typical fall in the upfront premium if the recovery rate increases by 1%. Now this is how we get the calculations, right? I can also look at changing it for the 5-year contract as well. So I'll save this to 5, and probably instead of 189, I'll make it to 271.6 for a 5-year case. Now based on this, let me see what are the major differences I am observing, all else remaining the same. So you could see here the price is 92.54. The upfront is very high. The probability of default coming out to close to 20.57%. Based on the survival probabilities, this probability of default will get evaluated. So the upfront premium is coming out to 721. The accrual will still be the same in both the cases. So the principal is coming out to be this much. The spread is much higher. We know that 271.6. So spread DV01 here is 4,000. Interest rate increases by 1 basis point. I see that the upfront is going to decrease by $183. Similarly, for a 1% increase in recovery, I could see that the upfront will go down by $1,368. So these are some of the important things that are coming out here. Then, if required, I can also do a few important calculations. Probably now we don't need to look at all these things, but within this package you can see if I want to calculate the upfront value when the spread rises by 10. So instead of 184, if the spread increases by 10 to 194, what would be the change in the upfront value? Here we have got the 0, 1, but this will calculate with respect to 10. Now once we have the probability of default, this is the probability of default that we have. Based on that, I can even compute the spread. So I need to give the probability of default as input, tenure as the input, So here it is 20% is the probability of default, tenure is 5 years, recovery rate is 40. Based on that, it can also compute the spread. So these are all like based on these numbers, I can do some kind of quick calculations here and there to typically get the whole set of computations altogether. So you can simply give the inputs as required, and based on that you should be able to compute the necessary values. But much more than that, I am looking at, let me take the structure of this val CDS. So these are some of the things that this is finally giving. The name is displayed, contract is displayed, the RED is displayed, the date we know it is 26 or 15 December 2016. The spread is 272, it got rounded up. The maturity date we did not compute it, we did not give it, but internally it took it, if you see, as 20th December 2021. We have just given it as 5 years, but based on that 5 years, because it takes only the 20th of those closest of the next possible quarters. So that's the reason 5 years means it should be 15th December 2021, but because the 15th December 2021 is not a standard maturity date, it has taken the next maturity date, which is coming on 20th December 2021. This is one calculation that it has done. Tenure we have given 5, coupon we have given 100, recovery is 40%, currency is dollar, the notional amount is this one, premium, the principal got computed, accrual got computed, probability of default got computed, the price is 92.5. Based on the yield curve that we have given, this is the price that got computed. This is the upfront that came out because of the difference between the CDS spread, traditional CDS spread, and the coupon payment that are coming because of the standardization. Then spread DV01, IR DV01, and associated with the recovery rate, what is the increase or the decrease in the upfront values. Apart from this, one more thing I thought I should look at is if the coupon becomes 500 instead of 100, I should see negative numbers, right? Because I am paying, the protection buyer is paying much higher compared to what is the CDS premium that needs to be. So the protection buyer is typically paying a much higher amount. So the valuation should give an upfront value negative, which means there should be a payout from the protection seller to the protection buyer. So now I could see the upfront is minus 1.113 million. Accrual being minus 120, the subtraction between the two giving the principal. The spread is still the same. IR is now going the other way, and even the recovery is also going positive in this case. So this is how the actual computations can very well happen. This R tool is quite comfortable in terms of understanding the various computations with respect to the credit default swap. So the first thing is talking about the credit default swap in case there was no standardization, and after that I am taking that as one of the inputs, and then went into the standardization part, finally computing how the upfront is increasing or decreasing in each of the cases. So this is what I wanted to cover as a part of the practical computations of the value of the credit default swaps using R. Any further clarifications you require, you can very well get in touch with me by giving me a call on the number that I have given below, or you can send in an email at vamsidhar@pacegurus.com. Thanks a lot for listening to this session. Thank you very much.